Looking at the latest news, you really have to ask yourself, is this high growth AI infrastructure stock exhibiting a falling trend and just glaring sell signals? Or is it, a strong buy that's genuinely undervalued?
Yeah, I mean, that is the defining question right now for both institutional and retail portfolios. Yeah. Trying to navigate the hardware side of the tech sector.
Right. And our focus today on this deep dive is Applied Optoelectronics, Inc. You probably know them by their ticker, AAOI.
So AOI.
Our mission today is to essentially tear through a massive stack of financial reports, technical analyses, and market sentiment just to understand the absolute whiplash surrounding this company.
And there's a lot of whiplash to go through.
Oh, definitely. Now, before we get into the weeds here, I really need to emphasize that this is a natural human debate based strictly on the provided source material. We're looking at the data, the trends, the history, but this is absolutely not financial advice.
No, definitely not.
Yeah.
We are just pulling apart the mechanics of the business to see what the market is actually pricing in.
Exactly. And hey, if you are tuning in on YouTube, be sure to like the video, subscribe to our YouTube channel, and we highly encourage, basically it's compulsory that you leave your feedback in the comments. We really want to know how you are reading this data.
Yeah, let us know what you think down there.
So let's establish the baseline here, because the recent history of AAOI is, well, it's chaotic. As of yesterday, April 21st, 2026, the stock closed at $150.57.
Right.
But getting to that number involved this sharp 7.89% decline in a single trading session. Nearly 8%, just wiped out by the closing bell.
Which is wild because that kind of daily contraction usually signals, a major structural failure or some disastrous earnings leak.
Yeah.
But when you zoom out, the context completely changes the narrative.
Right, because despite that daily drop, the stock is still up a staggering 350% year to date.
350, just massive.
To really grasp the sheer scale of this climb, you just have to look at the 52-week extremes. The 52-week low for this stock was just $9.71, and the 52-week high is $173.41.
Which is a crazy spread.
And they literally just set that high yesterday on April 21 before immediately tumbling. So I look at this price action, and it's like a rocket ship hitting sudden orbital turbulence. How much of this whiplash is retail traders just, chasing a hype cycle, and how much is based on actual company evolution?
Well, the retail hype is undeniable. Anytime the phrase AI infrastructure is attached to a ticker, speculative money just floods the order book.
Oh, absolutely.
But that speculative money is masking a very real, very painful, fundamental identity crisis within the company.
Yeah.
So AOI is attempting to graduate, right? Historically, they've been a cyclical telecom fiber provider.
Right, broadband upgrades.
Exactly. They made their money on standard broadband upgrade cycles. But right now, they are pivoting hard to become a high-scale AI component manufacturer.
Which is a completely different business model. You're moving from predictable, cyclical, local telecom contracts to trying to supply the optical nervous system for multi-billion-dollar data centers.
Yeah, the engineering tolerance alone is in a different universe. The market is attempting to price a company that is essentially tearing down its existing business engine and rebuilding it mid-flight.
That sounds incredibly risky.
It is. When you transition into the AI infrastructure space, the scale of demand, the required precision, the speed of delivery, it all changes overnight. The turbulence we saw yesterday at that $173 mark, that's the market struggling with execution risk. They love the theory of the pivot, but they're terrified of the logistics.
Well, if the market is terrified of the logistics, we really need to look at how this transition is bleeding into the underlying fundamentals. So moving to the financial deep dive, the income statement paints a picture of a company scaling aggressively, but perhaps at a dangerous cost.
Let's hear the numbers.
So for 2025, annual revenue hit $455.7 million. That's an 83% year-over-year increase. And Q4 alone brought in $134.3 million.
That's solid growth.
It is, but they are still operating at a net loss. The net loss for 2025 was $38.2 million, and the trailing 12-month EPS sits at negative 65 cents.
Right, but you kind of have to view that $38 million loss against their historical performance.
How so?
Well, in 2024, they posted a $186.7 million loss.
Oh, wow. Okay.
Yeah, so slicing a net loss down that dramatically while nearly doubling revenue, that tells us the unit economics of this AI pivot are actually starting to take hold. They're reaching a scale where the margins on these complex optical components are beginning to outpace the raw cost of production.
Okay, I see the margin improvement there, but the balance sheet introduces a whole new layer of anxiety for me. As of December 31st, 2025, total assets are sitting at 1.17 billion. They hold 216.04 million in total cash against 197.17 million in total debt.
So cash covers the debt.
On paper, yeah, the cash covers the debt. But the free cash flow for 2025 was a massive negative 384.66 million.
Yeah, that's a big number.
It is. I mean, they are burning through cash like a startup that just leased a skyscraper before securing a single tenant. I mean, where's all this money going?
That analogy actually highlights the core risk perfectly. They aren't just burning cash on, marketing or bloated payroll. That negative 384 million is almost entirely driven by capital expenditures.
Okay.
Specifically, they deployed 210.61 million purely on capacity expansion.
210 million just on expansion.
Yeah, because when you're promising to supply the physical infrastructure for next generation AI, you can't fulfill orders with software updates, right? You need physical clean rooms. You need specialized photolithography equipment. You need fabrication machines that take months to install and calibrate.
So they're essentially forced to spend that 210 million now, or they just bottleneck their own revenue potential in 2026.
Exactly. If they don't have the capacity online, the minute a mega-cap tech client asks for a shipment, that client goes to a competitor, and AAOI never gets them back. They are buying the physical footprint required to stay relevant in an arms race.
Well, if they're bleeding that much cash to build physical factories, the market must be demanding a massive premium for taking on that execution risk. And we are seeing that fear and optimism play out live in the order flow right now.
Oh, absolutely.
Let's look at the technicals because the chart is showing a very specific tug of war. The long-term trend remains firmly bullish. The stock is trading well above its 200-day simple moving average, and the MACD indicator is sitting bullish at 1.073.
Yeah, so the institutional belief in the long-term thesis really hasn't broken. Those indicators suggest that the smart money still views the broader trajectory as intact despite, the daily volatility.
Right, but the short-term indicators are flashing warning signs. The 14-day RSI cooled off rapidly down to 44.7 after the stock hit that 52-week high yesterday. It's moving out of overbought and into neutral or oversold territory.
Which is a natural correction.
Sure, but we're seeing heavy selling pressure acting as a brick wall of immediate resistance right at the $170 to $173 level. Meanwhile, buy orders are heavily stacked near the $145 to $150 support zone.
Right, so that's the battleground.
Exactly. And below that, we have stronger support at 142.16 and 135 even. I look at that $170 resistance, and I have to wonder if the long-term trend is still so incredibly bullish, why are early investors aggressively taking profits the second it crosses 170? Are they just taking their money and running?
Well, it's market psychology, and honestly, institutional risk management kind of mandates it.
What do you mean?
Imagine a fund that initiated a position near that $9.71 low. When an asset appreciates 350% in a single year, it completely skews the risk weighting of an entire portfolio.
Oh, I see. It becomes too big of a piece of the pie.
Exactly. It becomes a massive concentration risk for the fund manager. So selling at 170 isn't necessarily a vote of no confidence in the company's future. It's just the algorithmic reality of securing life-changing gains. The market collectively looked at 173 and decided that this price fully captures every ounce of future growth they're willing to underwrite today.
That makes a lot of sense.
Yeah.
And that dynamic between the buyers waiting at 145 and the sellers defending 170, it's a perfect proxy for the broader existential debate happening among financial analysts right now.
Yeah, the classic undervalued versus valued trap debate.
Precisely. Is this stock actually an undervalued opportunity waiting to break out, or is it a dangerous, highly volatile trap? The overall consensus is a hold, specifically a Zacks rank number 3.
Okay.
While the technical indicators flash strong buy, human analysts at firms like Raymond James maintain an outperform rating but explicitly urge caution on the valuation multiples.
And the valuation models are really where the friction shows up. By price-to-sales standards, AAOI looks heavily overvalued.
Yeah, they're trading at a 10.73 times multiple, while the broader industry average sits at 8.77.
Right, so if you strictly value the company based on the components they are shipping out the door today, you are definitely overpaying.
But the counterargument there is the forward-looking intrinsic discount. The model suggests that a 10.73 PS ratio is only a premium if their growth stalls. If AAOI actually hits their stated 2026 revenue target of $1 billion.
Which is a huge target.
It is. But if they hit it, you are buying the stock at a massive discount today. But getting from $455 million in 2025 to $1 billion in a single year, that is a staggering operational leap.
It requires absolutely flawless execution. The bull case hinges entirely on that leap. And to be fair, the bulls do have tangible evidence.
Like what?
AAOI recently secured a $200 million plus order specifically for 1.6T transceivers.
Yeah, a $200 million order?
Yeah, and to put that hardware into context, 1.6T transceivers are the absolute bleeding edge of optical data transfer. They are basically the arteries required to connect the newest generations of AI GPUs.
Wow.
And to fulfill that order, AAOI is aggressively expanding their Texas manufacturing footprint to 900,000 square feet. That CapEx spend we discussed earlier.
The $210 million.
Exactly. That is the 900,000 square feet becoming a reality.
So the bulls look at that $200 million order book and the factory expansion, and they argue that the demand is already locked in. The $1 billion target isn't just some theoretical projection. It's mathematically scheduled if they can just get the products off the assembly line.
Right. But the bear case is just as compelling. And it centers on who is actually placing those orders.
Oh, the customer base.
Yeah, AAOI carries a terrifying amount of customer concentration risk. They are heavily reliant on just two mega clients, Amazon and Microsoft.
Just two.
And the hardware supply chain, having two clients account for the vast majority of your revenue means you have absolutely zero pricing power.
You are effectively a hostage to their capital expenditure cycles. If Amazon decides they want a 5% discount on the next batch of transceivers, AAOI has to accept the margin compression, or they lose half their revenue base overnight.
Yep.
They don't have a diversified portfolio of 1,000 mid-sized clients to fall back on.
And compounding that leverage is AAOI's historical struggle with firmware delays.
Oh.
In the AI infrastructure race, time to market is the only metric that matters. If Microsoft is waiting on AAOI to patch a firmware bug before they can bring a billion-dollar server cluster online, Microsoft isn't going to wait patiently.
They'll just go somewhere else.
Exactly. They will simply qualify another vendor for the next upgrade cycle. A single delay doesn't just cost AAOI a quarter's revenue, it costs them their seat at the table.
It's really interesting to look at insider activity through the lens of that immense pressure. If the top executives genuinely feared that the customer concentration risk was going to break the company or that the firmware delays were unfixable, you would expect to see them cashing out at that $173 top.
You definitely would.
But the SEC filings show no major open market selling by top executives over the last 30 days. We've only seen employee inducement grants. The people inside the building aren't running for the exits, which signals serious internal confidence in the Texas facility ramp-up.
Well, internal confidence is a strong metric, but it doesn't protect the everyday investor from the inherent volatility of the stock. And that's really where the downside risks are.
The retail traps.
Exactly. Retail traders frequently get trapped in these transition narratives. They read a headline about a $200 million AI infrastructure order, they see the chart going vertical, and they buy in during absolute euphoria at that $173 high.
And then the RSI cools off, institutional algorithms take their profits, and the stock experiences a mechanically normal 8% pullback down to 150.
Yep.
The retail trader panics, assumes the fundamental thesis is broken, sells for a loss, and gets shaken out of the position right before the stock finds its support at 145 and consolidates for the next leg up.
Because when a stock is up 350% year to date, daily swings of 5, 8, or even 10% are just the cost of admission. You are strapping yourself into an asset that is trying to rebuild its entire corporate identity.
So, synthesizing this technical tug-of-war, the heavy CapEx spending, and the intense fundamental debate, the outlook here requires separating the noise from the timeline.
How do you mean?
Well, from a short-term perspective, anyone holding this stock should expect violent, extreme volatility. The buyers at 145 and the sellers at 170 are both just holding their breath for a major catalyst. And we know exactly when that catalyst arrives.
May 7.
Exactly. The Q1 2026 Investor Relations earnings call, officially scheduled for May 7th, 2026.
May 7th is the moment of truth. The market isn't going to care about forward-looking promises anymore. They are going to demand concrete updates on the Texas factory expansion.
Right.
They're going to want proof that the 1.6T transceivers are actually shipping without firmware bugs.
Right.
And most importantly, they need to see that the profit margins are surviving the pricing pressure from Microsoft and Amazon.
So until that call, the stock is likely going to ping pong between its support and resistance levels as traders try to front-run the news.
That's the most likely short-term scenario, yeah.
And from a long-term perspective, the broader outlook remains bullish, but it sits on a knife's edge of execution. It's entirely dependent on successfully ramping up those 800G and 1.6T transceivers.
Yep.
If they execute, they hit the $1 billion revenue target, the shrinking net loss flips of profitability, and the current 10x valuation suddenly looks like a huge bargain. But if they stumble on the engineering, the entire narrative grumbles.
I mean, they have managed to position themselves with the right hardware at the exact right moment for the wealthiest clients in human history. The theory is perfect, but the physics and logistics of actually building it, that will determine the stock price.
Which brings us to the real unknown. If AAOI actually pulls this off, if they scaled the Texas facility, hit the $1 billion target, and flawlessly solve the optical hardware bottleneck for Microsoft and Amazon, what breaks next?
That's a great point.
It makes you wonder. So as we stare down that May 7 earnings call, you have to ask yourself, are we witnessing a healthy temporary pullback before AAOI's real AI breakout, or the beginning of a harsh, undeniable reality check for a heavily concentrated supplier?